Welcome to Tech Money Madness Weekend Edition, your bite-sized investor education series. Today's topic, options basics, calls, puts, and why people use them. So, for today's deep dive, our mission is really to demystify what can feel like a totally intimidating world, the world of options trading.
Yeah, it definitely scares a lot of people off.
Right, it just sounds like Wall Street jargon.
Okay.
But we're going to unpack what options actually are, how they work, and, why they aren't just for financial insiders. And to do this, we're pulling insights from a few different places, Wikipedia, Investopedia, and some pretty dense notes from the CFA Institute.
Oh, yeah, the CFA material doesn't mess around. But if we start at the very beginning, Wikipedia actually has a really great, clean definition of the fundamental concept.
Okay, lay it on me.
So an option is basically just a contract.
Yeah.
This contract gives the owner the right, but importantly, not the obligation to buy or sell a specific quantity of an underlying asset. And you do this at a specified strike price by a specific date. So if you can just internalize that phrase, the right but not the obligation, you basically understand the core of the whole system.
The right, but not the obligation. Okay, so let me try to put this into an everyday analogy for everyone listening. Imagine you want to buy a house, right? But you're a little worried about a potential housing crash. What if you could pay a tiny non-refundable deposit today to guarantee you can buy that house at today's price for an entire year?
Yeah, that's exactly it.
But you retain the absolute right to just walk away, completely risk-free if, the foundation cracks or the market just completely tanks. So you're essentially paying for a choice. You've secured the opportunity without taking on a massive mortgage yet.
That's a perfect analogy. You nailed it.
Yeah.
You are buying a choice.
Okay, but here's my question. If an option is just paying for a choice, why do investors use them instead of just buying the asset outright? Stocks are so liquid I can pull out my phone and buy shares in 3 seconds. Why pay a fee just to have the choice to buy it later?
Well, that's a really fair question. And to answer it, we sort of have to look at the two distinct flavors of options, which are calls and puts.
Calls and puts. Yeah.
So they represent opposite sides of the market. A call option gives you the right to buy an asset at a specific price. You can think of it as calling the asset toward you.
Got it.
And then a put option gives you the right to sell the asset at a specific price. So you're putting it away from you onto someone else.
Wait, let me stop you there. So if I buy a put, which is the right to sell a stock, I'm basically just shorting the stock, right? Like making a bet that the price is going to drop.
Well, not exactly. And this is where the CFA Institute notes get into the weeds, because an option's value is highly complex. It's classified as an asset or a contingent liability.
Okay, that sounds like textbook speak. What does that actually mean for me?
It means its value isn't just a simple one-to-one match with the stock price. The valuation equation depends on a really complex relationship between a bunch of moving parts.
Like what?
Like the underlying asset price, the strike price you agreed on, the time left until expiration, the market volatility, and this one always surprises people, the risk-free rate of interest.
Wait, hold on a second. Time and volatility. Does that mean I'm basically buying an expiration date and, a mood swing?
Yes, actually. That's a great way to put it. You are literally paying for time and uncertainty.
Wow. Okay.
Because think about it.
Yeah.
If you have an option that expires in a year, you have 12 whole months for the market to move in your favor. You're going to pay a much higher premium for that luxury than for an option that expires tomorrow at 4 p.m.
Right, because there's just more time for something crazy to happen.
Exactly. And volatility works the same way. If a stock is swinging wildly all over the place, the uncertainty is higher, which means the potential payout is higher. So the option costs more. Time and uncertainty directly impact the value.
Okay, so based on all this complexity at the time, the volatility, the calls, the puts, why go through the hassle? According to, the sources, what is the actual why here?
Well, Investopedia highlights 3 main reasons investors jump into this. It's hedging against potential losses, speculating on price movements, or generating income.
Let's talk about hedging first. That sounds like the safest one.
Yeah, hedging is basically like buying an insurance policy. Let's say you own a stock, and you're worried the company's going to report terrible earnings next week.
But I want to sell my shares and deal with the taxes.
Exactly. So instead, you buy a put option. This acts as insurance. If the stock crashes, your put option guarantees you can sell your shares at the agreed-upon higher price. You're protected from the decline.
Ah, okay. So it's literally collision insurance for my portfolio.
Right. And then on the flip side, there's speculating. If you strongly believe a stock is going to rocket up, You could buy a call option. This allows you to speculate and potentially profit without having to put up all the cash to buy the actual shares up front.
Because I'm just paying that smaller premium instead of buying 100 shares.
Exactly. And the CFA Institute notes that this flexibility is huge because it allows investors to precisely adjust the risk profile of their entire portfolio.
Okay, hedging and speculating sound great in theory, but I'm trying to picture this. If I actually want to go out and execute one of these trades, how do all these moving parts, the strike prices, the premiums, the expirations, how does that actually fit together on the ground?
Sure, let's build a trade. When you're ready to do this, there are 4 pillars you have to choose.
4 pillars, got it.
Number 1 is the type, so call or put. Number 2 is the strike price, which is your agreed-upon transaction price.
Okay.
Number 3 is the expiration date. And number 4 is the premium.
Let's focus on that last one, the premium, because paying a fee is the part that always hurts.
Yeah, but here is a really critical insight from the CFA Institute that you have to remember. The premium is the price the buyer pays the seller for the option, right? But crucially, this premium represents the absolute maximum potential loss for the buyer.
Wait, really? The maximum?
Yes. Let's walk through a concrete example so you can see the math. Let's imagine a scenario with a stock that is currently trading at exactly $50.
Okay, $50 stock. I'm following.
And you buy a call option for 100 shares of this stock. You set your strike price at $50, and let's say the premium you pay is $2 per share.
Okay, so since options are usually in bundles of 100 shares, I'm paying $2 times 100, so a $200 premium total.
Exactly. You just paid $200 in cash up front. Now, let's look at the winning scenario. A few weeks go by, and the stock goes up to $60.
Oh, nice. Okay, let me do the math on this because I love a winning scenario.
Walk me through it.
So the stock is at 60. I exercise my option, which means I get to buy my 100 shares at my locked-in strike price of $50.
Right.
Then I immediately turn around and sell those same 100 shares on the open market for the new price of $60. So I make $10 a share in profit.
Yep, $10 times 100 shares.
That's $1,000. And then I just have to subtract the $200 premium I paid at the start, so I walk away with $800 in pure profit. That is a massive return on a $200 investment.
It really is. That's the power of leverage when speculating. You controlled a large amount of stock for a small fee.
And this is the big but. What about the losing scenario?
Yeah.
Let's say my research was garbage and the stock drops to $40.
Okay, so the stock is at 40.
Right. So if it drops to 40, am I legally forced to buy 100 shares at the overpriced $50 mark? Because my contract says 50. Am I completely ruined here? Am I on the hook for all that money?
Not at all. And this goes right back to the core definition we started with. It is a right, not an obligation.
Phew.
Okay. Yeah, if the stock is at $40, why would you force a transaction to overpay at 50? You simply don't exercise the option.
I just let it go.
You just let it expire. Your total loss is capped exactly at the premium you paid up front. So you lose the $200, and that's it. Nothing more.
Wow. Okay, so my downside is strictly capped at the premium, but my upside could be huge, like we saw in the winning scenario.
Yep.
I mean, honestly, that sounds almost too good to be true. Where do people mess this up? Because people definitely lose their shirts trading options.
Oh, they definitely do. And the biggest danger, and Investopedia explicitly warns about this, the biggest pitfall, is simply a lack of understanding.
Just diving in blind.
Exactly. Investors dive in without fully comprehending the complex risks and the potential rewards. They see the leverage, they get greedy, and they make poor decisions, like buying options that expire in 2 days, hoping for a miracle.
Yeah, that makes sense. Which actually brings up a common misconception I hear all the time. There's this idea that options are somehow elitist. Like they're only for Wall Street insiders or, highly sophisticated hedge fund managers.
Yeah, that's a huge myth.
So it's not true.
No, it's not. I mean, are they complex? Yes. But they are a highly useful tool for individual investors. If you take the time to learn the mechanics, like understanding that maximum loss is just the premium, regular people can absolutely use these to protect their portfolios.
Right, like the car insurance analogy we talked about.
Exactly. But that being said, there is a massive mistake that new investors make, and the CFA Institute calls this out specifically.
What's that?
It's confusing options with other derivatives, specifically futures or forward contracts.
Ah, yeah. I hear those terms used interchangeably all the time on financial news.
They get lumped together, but they are fundamentally different.
Okay, let me try another analogy here to see if I'm getting this different. So an option is like holding a reservation at a fancy restaurant. You put down a deposit, but if you change your mind, you can decide not to show up and you just lose your deposit.
Right.
But a future or a forward contract, does that mean you've already ordered the meal and you absolutely have to eat it and pay for it no matter what? Like even if you lose your appetite?
That is exactly right. Futures and forwards require the buyer to take delivery of the underlying asset. If you agree to buy oil at a certain price on a certain date using a futures contract, you have to buy it. You are legally obligated.
Oh, wow. So there's no walking away.
None. But options do not have that requirement. With an option, you can always walk away and just lose your premium.
That is a massive distinction. I will definitely stick to making restaurant reservations where I can just bail and lose my deposit.
It's definitely the safer place to start.
All right, so let's synthesize all this for everyone listening. We covered a lot today. Here are the key takeaways. First, options are contracts granting you the right but not the obligation to buy, which is a call, or sell, which is a put an asset at a set strike price and date. Second, they are really powerful tools for managing risk, generating income, or speculating. But you have to understand that your premium is your maximum loss, and you can't confuse them with mandatory futures contracts. So definitely use educational resources to learn more before you dive in.
For sure. And I want to leave everyone with one final, deeper thought to ponder, which goes back to those CFA valuation metrics we talked about.
Okay, what's that?
Well, when you trade an option, you aren't just making a bet on a company's fundamentals like you do when you buy a regular stock. Because of factors like time to expiration and market volatility, you are literally putting a price tag on time and uncertainty itself.
That is wild to think about.
It is. So if you're going to trade them, you have to ask yourself, are you confident enough to predict not just what will happen, but exactly when?
Oof, that is a tough question to answer, but a great one to end on. That's all for this weekend's deep dive. Come back tomorrow for more investor education and weekdays for daily market coverage. Like, subscribe, and we'll see you next time on Tech Money Madness.